earlier today, you spoke to investors and you said one of your biggest concerns was excessive leverage in the system. What are the ramifications of that?
Well, Sonali, we already were at record levels of debt on a number of measures from corporations when we got into January of this year. And one of my concerns was that when we have an economic downturn, this highly levered economy of ours was going to lead to more severe pressures on the economy than we would normally have. But now, the Federal Reserve has basically eliminated the downside in corporate debt. They've sent the world a buy signal, and we're now putting on record amounts of corporate debt. The leverage situation is even getting more exacerbated. So I think ultimately the Fed is going to find itself in a position where when it tries to phase out these programs of support for corporate debt, it will be a lot like what happened back in 2013 when Ben Bernanke first talked about ending quantitative easing. There was a tantrum. And so it's quite likely that the Fed will face that day of reckoning when it tries to slow down asset purchases of corporate debt. And the market will then challenge the Fed to find out where the put is. And I think this is now a permanent feature of the market.
So Bill Dudley has told Bloomberg that he believes that they're flirting with moral hazard here. What does that mean in terms of how companies may look coming out of this crisis? Help us understand what is at stake here.
Sure. Well, first off, I would quote Milton Friedman, who once said that nothing is so permanent as a temporary government program. The corporate America is going to become addicted to the Fed providing support. What I think it means, Sonali, is that corporations will take greater risk. That if you don't have a highly levered balance sheet relative to your competitors, your equity returns will be punished during business expansions. And so pressures will be on CEOs to continue to increase the amount of leverage, especially when the Fed has got a policy of maintaining low rates for an extended period of time. So I think that ultimately, is there a day of reckoning? I think that the Federal Reserve will be faced with the challenge of whether they allow a day of reckoning or whether they basically decide that they just have to continue to provide liquidity to the system until inflation rates pick up to levels that probably would be viewed as unacceptable by most participants of the Fed today.
Scott, we've seen record amounts of borrowing from corporations, but at the same time, if you look at downgrades, it's happening at a faster pace than we've seen in at least a decade. How do we pair off that thinking?
Well, it's really interesting, Sonali, because this, again, was something we had expected. We expected to see downgrades among high yield or in triple B issuers into the high yield category of about $1 trillion in a slowdown. I think that we're on pace to do that. But there's also another question, which I brought up today at the S&P conference, which is that the rating of a bond reflects the probability of default. And so when you have a government program that provides liquidity, you've taken away one of the major causes or sources of default, which is the inability to roll your debt maturities over. And so, you have to think that at some point, the rating agencies are going to start factoring in the implicit support of the Federal Reserve, and it's going to actually, in the longer run, reduce downgrades.
Another concern that's been coming up in the market a lot is the idea of zombie companies, and that's companies that are limping along, heavily indebted. Where do you see this going? What does that mean in terms of productivity and employment?
Well, ultimately, it's going to reduce productivity. You mean to talk about this for a minute, Sonali, there's a pretty commonsensical way of looking at this, which is investment occurs based upon projects which will not be very productive. Of course, there could be a side benefit to this. It could actually expand the number of jobs in the short run, but the long run implication is that it should also cause a period of stagflation, which we probably wouldn't see the consequences of for another decade or so.
I want to also address a lot of what's happening across America right now, because on one hand, you have this unprecedented Federal Reserve support for all types of companies. But on the other hand, you have this surging unemployment figure. And how do we pair off those two truths?
Well, it's really interesting because most of the support, though I know that there has been a valiant effort to help Main Street, most of the support is implicitly going to major corporations. So the majority of people in our country work for small business. And, we're going to have a large amount of business failures, which we already are having in small business. And so as the economy recovers, these businesses are not going to be there to create jobs, which is going to put more pressure on the Congress and the policymakers to come up with ways to encourage people to get back to work, to encourage businesses to reopen. Some of these businesses will never come back. In retailing, for instance, the amount of space or square footage dedicated to retail in the United States is approximately 3 times that of the next country, which is the United Kingdom. And so the fact that we've had such a glut in some categories like retailing, a lot of that is never coming back, and the jobs that are attached to it will never return. And we're going to have to retool workers, and that is going to be a major policy issue.
How do we think about the fact that if we need more support, at what point do debt levels matter for the U.S.?
Well, I mean, Sonali, I think the question is, how far can we push this? I quoted this morning, I like to say that, the American people need to have more confidence in the willingness and ability of its government to print money. The dirty little secret of central banking is that ultimately the role of the central bank is to finance the government. And so this open-ended financing from the Federal Reserve, I think, will continue and is going to give a lot of flexibility to Congress to pass additional support programs. Obviously, some of them may be very constructive and positive, but some of them might actually turn out to be highly disruptive to the capitalist system. And so I believe we are fundamentally in the process of altering capitalism in the United States, and the free enterprise system has a number of threats on a number of fronts.
Well, the idea of altering capitalism, inequality has been atop of people's minds as this crisis continues and as bankruptcies continue to mount. What do you mean by a different capitalism?
Well, I mean, look, the inequality of all types in our country, racial inequality, income inequality, wealth inequality, all of these things are the result of basically poor planning and programs out of Washington. The dispersion of income as a result of policies which have favored tax reductions, has basically exacerbated the income equality issue. And, one of the things also has been quantitative easing. If you came out of the financial crisis and you had money or assets, the returns you got over the next 10 years even exacerbated further the inequality among people who didn't have assets coming out of that crisis, or people who lost their homes in that crisis. So, these policies have been fundamentally flawed. They have failed to address the broader issues that Americans face. And this is going to, result in changes to policies coming out of Washington. The question is, will the policy changes that are coming out be done in a way which encourages increases in productivity and output, living standards for all Americans, or will it just become a fight for the pie? That is, that we need to cut up the pie again, and we need to basically transfer wealth in some mechanism, whether that's through income or whether it's through taxation or expropriation. And those sorts of policies have historically proven not to be very productive and to actually lower living standards over long periods of time.
Right.